So next we have leverage ratios, also known as solvency ratios. These ratios tell us about what is the ability of the company to pay down its long-term obligations. Okay, what is the ability of the company to sustain in the long term? In the current ratio, we looked at what is the ability of the company to fulfill its short-term obligations, right? So those were more related to working capital, but here we are talking about leverage ratios, which are more related to long-term obligations or non-current liabilities. One of the important factors we need to keep in mind while evaluating any company is the amount of debt funding they have, right? The amount of proportion of debt in the capital structure. What happens is that debt in the long term can create problems. Why? Because when we are funding through debt, debt can be relatively cheaper than equity. I mean, if we talk about cost of debt would be lower than cost of equity for the company. But the problem with debt is that you need to definitely pay it down, right? That means if you default on, if any company defaults on debt, it would have a significantly bad impact on the reputation of the company. The credit rating agencies would suddenly provide a rating of D for the debt of that company, and obviously the stock price will uh, take a beating if the company defaults on debt. So when we are talking about any business, there are different cycles uh, which a company may go through, which any business goes through. It can be a period of good earnings, boom, or it can be a period of lower earnings, or maybe some losses in case of very bad economy. So, whatever be the scenario, the company needs to pay down the debt. Yeah, that is like a fixed obligation. Whereas in equity, if you are not making much profits, you may not pay dividends, right? So that is more of a choice the company has. But in case of debt, there is no choice. These are like fixed commitments which need to be fulfilled at fixed intervals of time. So that is why from risk perspective, higher the debt, the riskier the company starts becoming. So the debt level should be very manageable, which the company can easily fulfill through cash generated from operations by the company. So this is what leverage ratios focus on. That is more on the capital structure side, or more on the debt capital side. What is the debt proportion? How much the company is relying on debt for running its operations, and that would determine whether the company would remain solvent in long run or not. That's why they are also known as solvency ratios. These are financial measurements that evaluate how much a company depends on debt to fund its operations and the potential risk associated with this indebtedness. As I said, higher the debt, higher the risk, uh, especially if the debt is above the manageable levels, then it can create significant problems for the company in the long run. So, in the long run, will the company be able to sustain or not? Uh, if you want to check that, or if you want to check the riskiness of the company with respect to its capital structure, leverage ratios is what we look at. Leverage ratios are essential for investors and creditors to assess a company's financial risk, its debt management strategies, and its ability to fulfill long term obligations. They offer insight into a company's capital structure and its capability to generate returns for its shareholders. Leverage ratios include debt to equity, debt to capital, financial leverage, interest coverage ratio, and debt service coverage ratio. So there are various ratios within the this category of leverage ratios. And if you see, they are primarily focused on what is the capital structure mix, what is the funding mix for the company, and what is the ability of the company to pay its interest obligations or pay its principal payment obligations. So let's start with debt to equity ratio. Debt to equity ratio, as the name suggests, it is total debt upon total equity. It illustrates the percentage of financing derived from debt related to shareholders' equity, right? So, what is the percentage of debt as compared to equity? That means a debt to equity ratio of uh, 1 by 10 means debt is just 10% of equity. Yeah, total debt is 1 and let's say total equity is 10. So my ratio will be 0.1, that is 10%. So my debt is 10% of equity, which is very much manageable and should not create problems for the company in long run, right? So this is what this ratio measures. What is the total amount of debt funding the company has divided by what is the total amount of shareholders equity. Total debt encompasses all long-term and short-term debts, including loans, bonds, and credit lines. So all of these forms of debt, all of these forms of interest-bearing obligations uh, encompass the total debt amount we have, and all of the total equity would include uh, com- company's assets after subtracting liabilities. So inside shareholders equity we have share capital, additional paid in capital, retained earnings, other comprehensive income, all of this part of total shareholders equity. We can also calculate total equity by simply reducing the liabilities from total assets. Interpretation: a higher ratio indicates that the company depends more on debt for financing, which may suggest heightened financial risk, right? So the more the company relies on debt funding, the more risky it becomes for the company to sustain in the long term. As mentioned, when the economy is not so supportive, when the revenue generation is not at the same pace, or when the profits are not being generated at the same level by the company, in bad times, during the bad economy, it may become a problem for the company to service its debt. By servicing the debt, we mean paying down the interest, um, paying down the principal repayments as and when they become due. So this servicing of debt can become a challenge in uh, challenging economy, and that is why we say a higher ratio indicates that the company depends more on debt for financing, which may suggest heightened financial risk. Conversely, a lower ratio implies a more conservative capital structure with less reliance on debt. So if the ratio is low, uh, do we want the debt to be zero? Uh, may not be the case, because debt financing uh, is relatively cheaper as compared to equity financing. So um, as long as the company is able to manage the debt, as long as they are able to restrict the debt funding to a very manageable level which they can easily service, there is absolutely no issue with debt funding to that level. But uh, a very lower ratio as compared to industry might suggest that the company is too conservative. So maybe they can increase their returns uh, on the capital by taking more debt, which is cheaper and which they can easily manage, which they can easily service, and generate more returns for the uh, capital providers by looking at a better capital structure mix than going for too high debt ratio or too lower debt ratio, debt to equity ratio. Next, we have debt to capital ratio. Uh, Here, we are talking about the total capital. So there are uh, there are two forms of capital. How the company gets funds is either through equity financing or through debt financing. So uh, uh, total capital the company has would include both debt and equity. So here we are talking about debt to total capital. So debt plus equity, right? So this ratio is a significant financial measure that assesses a company's capital structure by comparing its overall debt to its total capital, which comprises both debt and equity. So here we are comparing the total debt with respect to total capital the company has, right? So we are not just restricting to equity like we did in the last ratio. Here we are talking about the total capital. Total debt includes all forms of debt, both short term and long term, such as loans, bonds, and credit lines. So all the interest bearing obligations would come under this total debt category. Total equity represents the remaining interest in the company's assets after subtracting its liabilities. So again, total shareholders equity, we can either look at share capital, additional paid in capital, retained earnings, other comprehensive income, etc. Uh, and That's how we can calculate total shareholders equity, or simply we can do total assets minus total liabilities. That would also provide us total equity. So that's how we can calculate debt to capital ratio, by total debt with respect to total capital. Interpretation: a higher ratio indicates that a substantial portion of the company's capital originates from debt financing, suggesting the potential for increased financial risk. Uh, that means if the company is continuously taking more and more debt, then this proportion of debt to capital will keep on increasing, and it may reach from, let's say, 30-40% to 60-70%, 80%, which is not a good sign. That means 80% of my financing is done through debt, which is very risky for a company to sustain and remain solvent in the long run. Conversely, a lower ratio suggests a more cautious capital structure with a greater share of capital sourced from equity. Too lower ratio again would mean that we are relying heavily on equity only. Maybe we are talking about just 5% debt or just 10% debt. Uh, that is good from a sustainability perspective, but if the company has higher uh, ability to pay down the debt, companies generating a lot of good cash flows, then they can definitely slightly increase the debt funding to reduce the overall cost of capital for the company and generate higher returns for the capital providers. So again, these ratios need to be looked at from the industry perspective. Which industry we are talking about? IT industry doesn't need any debt, right? So if you look at these ratios for Infosys, TCS, Wipro, you might find that this is very small percentage or maybe even zero, right? But if you look at other set of industries like metals, mining, infrastructure companies, they rely a lot on debt funding. They need to take on a lot of debt to meet their working capital requirements and other capex requirements. So again, these ratios should be looked at from a particular industry perspective. If I'm comparing Berger Paints with Asian Paints, Kansai Nerlac, that makes sense. But I should not compare Berger Paints with L&T, let's say, right? So uh, for different industries, these ratios could be very different, and hence we should look at these ratios from a particular industry perspective. Okay, so that is about debt to capital ratio. Next we have is financial leverage. So again, it is one of the solvency ratios and this ratio, also referred to as the assets to equity ratio, serves as a foundation financial measure that quantifies the degree of financial leverage applied by a company. It evaluates the ratio of assets concerning shareholders' equity. So uh, again, it's more about capital structure. This is one more way of looking at the capital structure through financial leverage ratio, which is calculated as total assets upon total equity. So it is also used to measure the degree of financial leverage applied by a company. Uh, it is the ratio of assets concerning shareholders' equity. Total assets encompass all of a company's resources, encompassing both tangible and intangible assets. So when we talk about total asset, it means we are including all the assets here: tangible, intangible, current assets, non-current assets. So it is a total assets divided by total equity. Total equity signifies the residual interest in the company's assets after subtracting its liabilities. So total shareholders equity is like the owner's claim after the company has paid off the liabilities. Net residual claim, or we can also say net assets, that is total equity. So when we divide total assets by total equity, we get the financial leverage ratio. If you look at the formula, uh, total assets would overall increase if we raise more and more debt, right? So uh, our balance sheet is always matching in the sense that total assets is equal to liabilities plus equities. So if liabilities are increasing, that means proportionately assets would also increase. So if debt is increasing, total assets would increase, right? So this ratio would go higher. Yeah, keeping everything else constant. Let's say debt is increasing, so on the liability side debt will go up, so total liabilities will go up. And on the asset side, let's say cash is getting accumulated uh, through sourcing of funds through debt, so total assets overall would go up. So that means as the debt level increases, keeping other things constant, total assets would go up. And obviously this financial leverage would go up. So a high financial leverage ratio indicates that a significant portion of a company's assets is financed through debt, implying an aggressive capital structure with higher financial risk, right? So higher the financial leverage means company is relying more and more on debt financing. Its capital structure is getting more and more dominated by debt. So um, which would eventually imply that uh, financial risk is increasing. Like we discussed, higher the level of debt, it may become difficult to manage in difficult times during economic slowdowns, or some unforeseen circumstances when the company is not able to generate enough profits to service its debt. Then that higher level of debt, there is no optionality here. You have to service the debt, otherwise it will be considered as a case of default. So higher debt always increases the financial risk of the company. So here, if the financial leverage is getting higher and higher over a period of years, that means overall the financial risk of the company is increasing because they are relying more and more on debt, which can become difficult to manage in the long run. So ideally this ratio should be lower, uh, or it should be showing a decreasing trend if we are doing the trend analysis. Conversely, a lower ratio suggests that the company relies more on equity financing, potentially signaling lower financial risk, right? So lower equity, lower reliance on debt means lower risk. But again, what is that optimum level of debt? That depends from company to company, from industry to industry. Different industries operate with different levels of debt in their capital structure, and that's more on the business model side of how that industry works. So again, we should look at this ratio also from the perspective of that industry. What is the standard? What is the benchmark in that industry? And then we can comment on the financial leverage for a particular company by comparing with its peers. Next, we have interest coverage ratio. It is again a part of solvency ratios only. Uh, Here, uh, we are talking about what is the ability of the company to service its interest obligation, interest expense, right? So, as we know, whenever a company takes debt, they need to make regular interest payments. So, what is the ability of the company to timely pay its interest payments? That is measured through interest coverage ratio. It is calculated as EBIT upon interest expense. EBIT is earnings before interest and tax. So if we look at the structure of income statement, trying to look at the annual filing of Coca-Cola. Yeah. So here, um, yeah. So if we see here, uh, we have revenues minus COGS will give us gross profit, minus operating expenses will give us operating income, and from there we pay the interest expense, right? So uh, although there could be some non-cash items included, but broadly speaking, higher the operating income, we can say the higher the ability the company has to pay down its interest expense easily, right? So considering this to be for this particular scenario, let's assume that these are cash earnings, cash operating earnings. So this is the ability, or this is the amount of cash the company has generated in this particular year, and they can easily pay down the interest expense, right? So from EBIT we'll deduct the interest expense. So that is why this ratio is formulated like this: EBIT upon interest expense. So higher the EBIT as compared to the amount of interest expense, higher the ability of the company to service its interest expense from its operating profits. So that's why this ratio measures a company's ability to meet its interest obligations on its debt. Higher ratio indicates a stronger capacity to cover interest payments, and lower ratio indicates high risk of default or financial distress. Imagine EBIT is 100 and interest expense is 1000. So clearly the company cannot just rely on EBIT, those profits, to pay down its interest expense. They need to generate funds from somewhere else, or they need to use their cash balance to pay down the interest expense. So that is not a good sign. So ideally the EBIT should be much higher than the interest expense the company has to bear, and then we can say a higher interest coverage ratio will be there, and that means stronger capacity to cover interest payments. A ratio above 1 implies that the company can meet its interest obligations. So this ratio should ideally be more than one. That means company has a good capacity to pay its interest expense through its operating profits, and lenders and investors use this ratio to assess the financial health and risk of the company. So this would be very relevant in case of lenders, creditors. uh, when a bank wants to give the loan to any company, bank is concerned about whether they will get back their money along with interest or not, right? That is the risk a lender takes when uh, giving away the funds. So the first thing they would check is that what is the riskiness, uh, what is the ability of the company to pay the interest expense on time and pay down its debt principal payments on time. So this ratio is very relevant from checking the credit worthiness of the company. Very relevant for lenders before they lend out money to the company. They will definitely be looking at interest coverage ratio to check the ability of the company to pay its interest expense. Next is debt service coverage ratio. This is the last among the solvency ratios. Again, like interest coverage ratio, this is very relevant for the lender. Before they give out the loan, they would definitely not only be looking at interest coverage ratio but also debt service coverage ratio. DSCR is equal to net operating income plus depreciation divided by total debt service. So here we are not just talking about ability to cover interest, ability to pay down the interest expense, but also to make the principal payments. So here we are considering both the parts of servicing the debt, that is making interest payments as well as principal repayments for the long-term debt. So this is calculated as EBIT plus depreciation. Here we have added back the depreciation because it is a non-cash expense. So EBIT plus depreciation will give us roughly the amount of uh, cash profits, cash operating profits the company has generated, and from those, does the company has the ability to pay its interest expense and long-term debt principal repayments. That is captured through DSCR ratio. This ratio measures a company's ability to meet its debt repayment obligations. Higher ratio indicates a stronger capacity to cover debt service. So, um, higher the ratio means the company has higher ability to cover its debt service, to pay its interest and to pay long-term debt. A ratio above 1 implies the company can meet its debt obligation. Lenders and investors use this ratio to assess the company's ability to service its debt and the associated risk. Depreciation is added back as it is a non-cash expense and it reflects the cash flow available for debt service. So adding back depreciation is done because it is a non-cash expense and it is not impacting the cash flows. So EBIT has already uh, deducted the depreciation, so we are adding it back to make it more relevant in terms of actual cash flows available to service the debt. Okay. So let's look at the workings now. How do we calculate these ratios? First is debt to equity. So we'll look at total debt. Total debt can include short term as well as long term debt. This is our short term debt plus this is the long term debt. Short term debt plus long term debt divided by total shareholders equity will give us debt to equity ratio. So it is only 2.3%. Yeah. So debt is just 2% of the amount of equity. If you see, the debt amount here is 89, 139, whereas shareholders' equity is 99 lakh 43,835. So equity is a much larger amount as compared to total debt. So this is captured through debt to equity ratio. We can say it is 0.023 or 2.3%. Okay, so it's a very small amount. That means very small amount of debt as compared to equity. That means very manageable debt. The company is not relying too much on debt financing as compared to equity financing. Let's look at debt to capital. So here again we'll look at total debt. Short term plus long term. Divided by total capital. So that means equity plus debt we'll do here, not just equity, but we will do debt plus equity. Okay. So because the debt financing is very less, that's why this ratio is also very small, 0.0225 or 2.25% only. Next, let's look at financial leverage, which is equal to total assets upon total equity. Total assets here we have current assets, non-current assets. So this is total assets divided by total equity. This is total shareholders equity. Okay, so this is our financial leverage, total assets upon total equity. Looking at these numbers, it is going up slightly from 1.14. It has reached 1.31. So we can say that company is relying little more slowly on debt. That's why this ratio is going up. And lastly, we have debt service coverage ratio, which is EBIT plus depreciation upon interest plus long-term debt. So first, let's do EBIT plus depreciation. This is EBIT plus depreciation. Divided by interest plus long-term debt. Interest expense plus long-term debt. Okay, so very good debt service coverage ratio. It's quite high. So that means company has very good ability to service its debt through its cash operating profits. It is 16 times, 19 times, 25, 21 times. So this is a very strong number in the sense that we can say that the company should be able to easily service its debt obligation through its cash operating profits. This is done. Solvency ratio.